Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for the new year, January 4th of 2026. Hope everybody had a wonderful new year and holiday season, and I guess it's time to get ready for 2026 and see what the future will hold for us. Right now, we have some economic data. We've got to look back here on third quarter GDP, which is the most recent data that's available. We get a first reading of GDP generally the third week of the month following the calendar quarter in which the GDP is measured, and then we get two revisions to that. And so what we have now is the final revision of the third quarter GDP numbers. You can see here we got 4.3%, very, very strong. This chart is illustrative in the sense that it gives you a sense of what contributed to overall economic growth in the quarter and what detracted from it. And so you can see here in the red, various points in time, inventories. When you get bloated inventories, you got to sell through those inventories. It becomes a headwind because generally production slows. And so inventory can become a volatile component of economic growth. And you can see very slightly negative here in the current quarter, following second quarter number, which was a fairly big offset by inventories. But here you can see consumption remains fairly strong. That's been a consistent theme throughout with a rare exception here. But also you get business investment, which contributed as well as net exports. So this time we actually had two solid quarters of trade. First quarter was a negative GDP print. And we talked about this quite a bit first half of last year, that net trade was a real headwind as people were importing more to get ahead of the tariffs. Well, that reversed itself, and we continue to have strong net exports in the calendar quarter of July through September. So you can see here various components, 4.3%. That did beat the estimate. So this is a very good quarter from an economic growth standpoint. Now we'll look at contributions, looking at like 1 and 10-year averages, so we can kind of get a sense of what feels normal, even though the data from one quarter to the next can be a little volatile. Here we've got the latest data in the amber line here, but if you go back 1 year, that's in the blue. So overall economic growth, 1 year average, a little bit less than 2%. You go 10-year average, overall growth is around 2%, but you can see where that kind of falls out, like particularly in the blue and the black here. You get business investment, which typically is a consistent contributor to overall economic growth. Residential investment, we know that we've had significant underbuilding in the residential space, and we also know that there have been a lot of affordability headwinds and some dislocations in this, so not a big contributor. Government spending has certainly played a part, as has net trade on the export side, and imports, which offset that. And you can see that, really over the last year, we've had net benefit from trade, as we saw in that last slide. But when you get over the 10-year average, you get imports that are slightly ahead of exports, which means you have a net negative impact from trade. And then inventories, as I mentioned, really kind of neutral when you get out into the long term here. Talk about the Atlanta Fed GDP now. So, now that we've transitioned through the first 3 calendar quarters of the year, and we've concluded the year of 2025, we'll get the first reading of fourth quarter GDP coming up here in another 2.5 weeks to 3 weeks here. And you can see that that's falling in right around about 3.5%. And you can see the third quarter here, we ended up the GDP now, the predictor, as it were, was somewhere close to 4%. And obviously that last revision was ahead of that. But the bottom line here is that economic growth is expected to remain favorable. And I think this, coupled with profits from looking at it from a stock perspective, have really kind of fueled this optimism, albeit uneven optimism across the various income cohorts. But at least when you talk about the investor class, and the higher income cohorts. I mean, the feeling is actually very good right now, and this number seems to corroborate that. You can see that looking ahead into fourth quarter, it looks like we're going to have a little bit of an offset here from imports and exports. You basically net these two out to get the net impact of trade. So exports being in the red, and it looks like imports by the Atlanta Fed's judgment, it's going to be a little bit more than exports, so that we'll have a slightly net negative impact from trade. So this slide's going to require a little bit of explanation, and what this represents here is, basically going back 25 years since 1999. These are the percentile ranks in these various components, where we talk about economic cycle components as well as valuation components. And so let's start on the left-hand side. So when you think about the percent change year over year in U.S. core personal consumption expenditures, which is the Federal Reserve's primary inflation measure, that basically since 1999, the current level of change year over year, basically, let's call it the current level of inflation, is higher than 86% of observations dating back to 1999, in very loose terms. And when we look at the unemployment rate, it's basically in the 38th percentile, which means it's relatively low, in this latest year relative to all of the different observations since 1999. So again, over 25 years, you've got core PCE, which is kind of at the upper end of the range. You've got unemployment, it's at the lower end of the range, and you have debt as a percent of profits at the corporate sector very, very low. So corporate enterprises are in relatively good shape from a balance sheet standpoint. Now let's talk about valuation. So not too surprisingly, when we look at S&P 500 valuations, they're higher than, call it 94% of the other 24 years since 1999. Credit spreads are really, really tight, so very high, very rich, very tight spreads relative to the historical backdrop, whereas 10-year Treasury inflation protected securities are at the lower end. So very high degree of complacency, despite the fact that we have higher than average trend in inflation. Now on this slide, we have some research from Goldman Sachs giving us some insight into at least what they think are going to be the various impacts on economic growth heading into next year and even the first half of 2027 that really kind of go beyond what we've just kind of described to you in so far as inventories and business investment and those things are concerned. These are some of the more the esoteric kind of policy issues that we're dealing with right now. So it's kind of like, obviously 2025 is in the books, but as we start the new year, you've got these various impacts that kind of collectively give you a sense of where GDP is gonna shake out. And so here in the first quarter, think about financial conditions, and that's just basically the overall condition of the economy, which is favorable, is expected to be generally favorable for the first half to the majority of the year. Then you have the fiscal impulse, and I'll kind of define this as the One Big Beautiful Bill Act. And so that's definitely, these are two headwinds that kind of help contribute to what should be a fairly decent economic growth setup for the first half of the year. Now, offsetting that, you have tariffs, but those impacts decline over time, which they should. When you think about when you impose tariffs, right, it changes that price level at that tariff level. And generally speaking, once you anniversary that change, then you cease to have those headwinds. And so that is basically what this is telling us, that tariffs become less of an issue over time. And then, of course, we've got the immigration effect, which is really not going to go away. When we think about the Trump administration and what they've done to curb immigration and how that negatively impacts a lot of the service industries. But the net takeaway here is that I think what's being set up for is a reasonable environment for the first half of 2026. A little bit more uncertainty on the back half, but basically impacts on growth overall that kind of mute themselves over time. Particularly when you talk about tariffs, and then you turn into fiscal headwinds here at some point next year when perhaps financial conditions get a little bit tighter and you get less impact from overall economic growth. And so I would just summarize this by saying a good setup for the first half of the year, more uncertainty as we get into the next 12 months thereafter. Now we have some conversation here on inflation. This is core inflation, year-over-year change. This goes back to 2019. You can see these various years at track, and this is a forecasted level. Again, Goldman Sachs research here being profiled. You can see that core inflation going down, U.S., same story, developed markets and overall world. So it's really setting up, and of course, the international markets had a really good year from a stock standpoint in 2025. And when you think about inflation and what the feedstock is for multiples to rise in equity multiples and risk capital, or I guess a risk appetite, I should say, becomes more in favor. That's certainly the setup that we have here, at least from an inflation point of view, heading into 2026. Now we'll look at that inflation picture from a different perspective. You can see here the lines that represent the U.S. are in black, developed world, ex-U.S. is in that blue, and then the emerging markets are in this kind of this amber line here. And you can see, again, as we were talking about inflation moving lower in all of these various constituencies, kind of setting up at least a good psychological environment for investments and risk-taking in the markets here in the early part of 2026. We've talked a lot about wage growth over the course of the year, and we do know that it's decelerating. We've got a plot on this chart from Apollo with inflation, basically relative to average hourly earnings. You've got inflation as noted by the Consumer Price Index. On this line, we've got average hourly earnings here. This is basically a 6-year percentage change. And so we do know right now, where we stand with inflation and with wage growth, even though we do know that we've had a deceleration in the growth of wages, that at least over a 6-year change that we're still outpacing inflation. So not only do we currently have kind of positive real wage growth, but we also have a longer term trend where wages have grown faster than inflation, which is good from the standpoint of purchasing power at the consumer level, even though aggregate prices are higher. And again, you've got a lot of people in the lower income cohorts that feel like things are tougher and they feel the brunt of increased costs of foodstuffs at the supermarkets and such. That at least we know from the data that wages have grown over the last 6 years at a pace faster than inflation. But as we know, there's always data inside the data. And so let's take a look at that right here. We've got some information from Bank of America. And this is basically higher income household wage growth relative to lower income households. And you can see here, lower represents the blue. You can see wage growth, as we've been talking about, kind of like in the aggregate, kind of like going down a little bit, which, you've got to define, the different brackets here. So you've got lower income folks, their wage growth is decelerating at a faster pace than higher income and certainly middle income. So that's the story within the story. And so you see this wage growth decelerating almost to a point that is now below inflation. That's where that K-shaped economy is coming from. And that's why we see those sentiment indicators, especially at the lower income cohorts, be so negatively impacted. Now we've got consumer confidence. You can see here we get, from the conference board, we actually get, different versions of this. And what's always reported is this black line here. This is the consumer confidence level. We do know that confidence has been coming down. That's not a surprise. The present situation is a function of that, as well as the expectations, which rarely gets commentary, but I think it's important as well. And expectations is really not doing that well either. In fact, all of these have moved down over the last year. And so I think it's important to note that, that sentiment is lower, even though the economy seems to be doing better. But again, this is filtering in filtering in this K-shaped economy component where you've got the lower income cohorts that just don't feel as good as those at the upper range. So on this slide, we talk a little bit about the labor market. We know that labor has been easing a little bit. We've got the unemployment rate here in the blue line. We know that that's been ticking up. That's not a surprise. But what I thought was interesting is the overlay line here of this black line, which is it's essentially a function of jobs that are hard to get minus those that are plentiful. And when you have this moving up as it is now, then jobs are generally speaking a little bit harder to get. What's notable in this is that a couple things here, kind of forget about the noise of the pandemic and just notice that pre-pandemic for many years, we had a decline here in unemployment. And, it was very symptomatic, a very expansionary environment. And we also had jobs that were increasingly plentiful to get. Now that is obviously moved the other way. And again, we've talked about this being rather unremarkable in the sense that, we have expected this and have been watching this for a long time. But what's interesting here is that this line seems to be accelerating at a faster pace than unemployment, which tells me that perhaps that we've got to reckon with this differential here, which might result in unemployment continuing to move higher to 5%. So that's my takeaway here, that right now the Fed seems to be concerned with the unemployment rate and labor in general, labor stability in general, more so than prices as far as their dual mandate goes. They feel like prices are kind of at a point where they can, begin to ease. And of course, the estimate now, after having come off that latest 25 basis point Fed rate cut, that there's perhaps another couple of rate cuts in the cards for 2026. If you get this moving up to 5, I don't think that that's going to happen, but we'll have to wait and see, just because labor is going to become more of an issue that the Fed's going to have to wrestle with if this thing moves up materially higher. Now we're talking about the impacts on economic growth over the next year or so. I want to take a little bit of a different slice at it here. This is actually was reported in the Wall Street Journal, data from the Budget Lab at Yale. But what I thought was really interesting is the annualized effect of the OBBBA and tariffs by income cohorts or by deciles here. And so what's interesting here, again, we talked about the K-shaped economy a couple of times now. This is one thing that I thought was very interesting, that you have a net negative impact until you get to really the top 30 or 40% of income deciles, that basically you have essentially a headwind from OBBA and obviously a negative drag from tariffs on the lower income cohorts. And what I mean by that is you've got some of the subsidies for healthcare being taken away, and there's some other elements of the OBBA that don't get really mentioned because they don't necessarily impact the upper income cohorts as much. In fact, by this estimate, it's a huge huge positive rather tailwind to them in the current year. Now we will talk about retail sales. So this is same store retail sales average. Again, pretty strong, pretty boring in the sense that it's not showing any particular trends. It's just kind of been steady. One of the things that this market has been able to hang its hat on. On this chart, we have credit card spending from Bank of America. You can see here, card spending overall was flat relative to the last handful of months here. And you see the year over year decelerating a little bit. So retail sales, looking fairly steady. Credit card spending maybe easing up a little bit. We know that defaults have kind of picked up just a tad, but may have crested, as the latest data readings on credit stresses within the credit card area have actually gone down lately, but they're slightly elevated. So it just seems like, this is not telling us anything overly significant other than consumption may be kind of like slowing just a tad. Here we have lower income spending growth. See was 0.6%, and that was a lot lower than we had for upper income cohorts. So when we talk about consumption, we talk about retail sales and so on and so forth, you can see, just as we did with some other things earlier in the slide deck, that you really have to break it down into the income cohorts to see who's really driving that and who's not. Here we have some real estate data. We've got the Case-Shiller 20-City Home Price Index, and you can see that, in a good sense that we've got some deceleration in the growth rate, but what that does not mean is a outright deflation in housing. That means that home prices are still going up. They're just not going up nearly as fast as they were, say in 2024 and obviously back in 2021, 22. And so when you look at the overall index of that price index, it continues to move higher, again, just not at the same rate. Slide over here to mortgage rates. You've got the everlasting or ever-standing relationship between 10-year Treasury yields, which are here. Again, those have been fairly steady, kind of range bound, and you see the 30-year mortgage rate, which is indexed to that 10-year Treasury. You can see that continuing to come down a little bit, and that spread's narrowing just a little bit here. We see that down in this bottom area. So you've got 6.1, 6.2% mortgages right now. I could see that perhaps coming down, 6 to 5.9-ish, but not a whole lot more than that, because again, you've got the historical spread between those two. And unless we see a material decline in 10-year rates, you're just not going to see those mortgage rates move that much. We'll talk about home prices. Again, this is a median household income ratio. Not too surprising that that's moved higher. So this is the affordability problem that we've been talking about. And again, this is 2015. So we had a pretty benign environment, and then it really kind of picked up after the pandemic, which we all know eased off a bit. And now we're in this this upward sloping trend line here. And so this is, again, what serves as the essence of the affordability issue. This is another way to depict that. This is from Visual Capitalist. I love their stuff because I'm not terribly visual, but this puts it in a way that I think most people can understand. So this right here represents median home prices. This is 1985, and even let's get a little bit closer, 2015. So 10 years ago, $289,000, and here in 2025, 10 years henceforth, we're about $426,800, and you can see that basically the median household income has only moved up so much when you think about it. And from 2015 to 2020, you actually had a deceleration in median household income. But clearly the takeaway here, and this is just reinforcing that last chart, that line that we showed you, is that you've got basically price to income ratio 5.1, which it continues to move higher on balance, with a couple of exceptions here, but it continues to move higher on balance and make it tougher for that home buying proposition. Now, this is a survey of individuals who expect their financial condition will be better off in the next year, and this is moved down lower. So this dovetails with the consumer confidence number that we looked at a little bit earlier. And I don't want to paint a negative picture. I'm just saying that amidst the optimism, and we'll talk about equity market expectations and things like that here in a little bit, but just to kind of temper that by saying that not all parts of this economy are firing on all cylinders, and we do have some stress, at least psychologically, and in the sentiment figure. Again, this is soft data. The hard data has been relatively good. Soft data continues to be soft, and this is just one more manifestation of it, as we saw in the consumer confidence figure. Distress In the loan markets is something else that we've been monitoring here. We've basically got default rates which are moving lower. Again, these are not incredibly high default rates, but particularly when you look at total issuers, and we knew that we were having an increase in defaults, those have moved down. In fact, the last few data readings here have been in the positive territory. So again, when we think about stress in the credit markets, we don't necessarily see it, even though it had ticked higher. But the last few data points in terms of credit have been positive declines in these defaults. Now we've got a couple of regional Fed surveys here. This is the Dallas Fed Manufacturing Index, is in the negative or contractionary territory, which it has been for most of the last 2 years, with some exceptions. And you look at new orders, you can see current new orders are pretty sluggish, pretty flat, again, as they have been. Future orders look to be trending higher. You get a little bit more optimism in that figure here in the Dallas Fed region. Now we'll look at Richmond Fed manufacturing activity. And these charts look very much like Dallas. You've got a lot of sluggishness in manufacturing. You've got sluggishness in new orders, but you have higher expectations. So maybe some green shoots looking into 2026 here. We'll take a quick peek at durable goods, which were in fact more negative than the estimate. We were looking for negative 1.5%. We got actually negative 2.2. This is monthly data, so as you can see here, quite noisy. But this did raise some eyebrows in the sense that it was negative more than expected. Now, if you back that out, back out transportation, I'd just say, then you got 0.2% positive. So data has been positive when you back out the volatile transportation components. And when you think about transportation, think about like Boeing and airplanes, which are really, really high dollar items that can sway that durable goods orders, that the order number quite a bit. But having said that, this was below the estimate once again, so showing a little bit more sluggishness near term in durable goods. Talk about a policy issue that I think we're really going to have to wrestle with. I think this is something that people are beginning to talk about now as we get on the the back nine, so to speak, of this decade, and we get closer to 2030. I think this is going to be a 2030s discussion. Is going to be interest costs on the federal debt. You can see here that basically we're about $1 trillion, and we talked about this. I mean, we spend more on interest on the public debt of the United States than we do on defense, and that number is only going to go higher. This is just a a baseline, and this could be an alternative scenario. And again, one of the things that if you're holding a lot of debt, that helps you is if you have a little bit of inflation, because that inflation kind of erodes that fixed debt that you have. Now, when you don't have inflation, if you're trying to drive that down, that makes this problem a lot more acute. So you're going to need economic growth that's going to at least pace this level of growth heading into the next decade. Otherwise, you're going to have the crowding out. So you're going to have spending in other areas that's going to be impacted because you've got to spend more money on interest. Dollar gets a little bit of attention here. Dollar's been in a bit of a down channel here. This is data that goes all the way back to 1996. So again, dollar is very cyclical. Honestly, we've been in a rising channel for the better part of the last, call it 20 years, with some exceptions here. Obviously, some oscillation, but we're at the lower end of that. What is really interesting in this analysis is, this comment right here. If the dollar breaks down below and goes below its channel, meaning the dollar gets weaker, and I do think the dollar is going to be probably range bound for a little bit. You've got some issues related to you know, fiscal policy and monetary policy that could influence the dollar. But again, you think about commodities, and this is this is saying that if you break below this trend line here, that you could really accelerate the commodity super cycle. And what that means is that commodities, most of which are priced in dollars, and if you have a weak dollar, that becomes very attractive to a lot of nations, to a lot of elements of the global economy. And so if you have those commodities that are priced in dollars and you have a weak dollar, that could set off a frenzy, so to speak, with regard to commodities. Now we'll switch our attention to the S&P 500, which ended the year positive. And so, basically this is total return. So we had high double-digit returns here, for 2025, and that comes off of 2 solid years prior to that, and then obviously 22. We know that things were abjectly negative to the tune of 20% here. But this is interesting and illustrative too, because it gives you the derivation of where those returns came from. And honestly, this is something we did not expect, that we were going to get a lot of benefit from earnings per share increase. We did not expect earnings to have the level of growth that we did. Certainly double-digit growth, and honestly double-digit growth that's expected for this coming year as well. But we got earnings growth, which really over the last 3 years has helped to fuel overall returns for the S&P 500. Now going back to 22, we had multiple contraction because of the abject environment that we were in, abjectly poor environment that we were in back then. That reversed in 2023, but we've had multiple expansion each of the 2 years ending in 2024, less of a benefit in 2025, and honestly I think we're going to get basically no benefit from multiple expansion in 26. We'll get whatever positive return that we get, more than likely is going to be a function of that little sliver of dividends plus earnings per share, but no benefit from multiple expansion. We'll talk about the different components and the different themes and strategies within the S&P 500. So we, and this is best illustrated through the ETF returns that kind of mimic these different themes here. So momentum did the best in the year. You can see in this chart we've got growth, buyback, companies buying back their own stock was a good theme. Here's the overall S&P 500, and then you see value, high dividend, quality perform a little less well. But let's keep in focus here that the S&P 500 that we live with today is not the S&P 500 that was in existence even 10 years ago, that we'll see in a second. And we'll reiterate the concentration of the high capitalization technology firms that were riding the AI wave. That's what's driving this growth. Very strong revenue for these companies, momentum. So this is probably more volatile over a longer period of time than all of this down here. And again, the average return in a normal year, call it 9 to 10% without a dividend. So you can see, small cap, mid cap, low volatility, underperformed relative to the index. But again, if you look at, dividend growth, quality, value, these over a long period of time are less volatile components than these are. And you can see here, technology and communications very strong in terms of total sector returns. Rather, these are factors. And then when you get down to some of the the areas, consumer staples, again, these are strong cash flow companies, strong dividend companies. They just didn't perform well. They were not sexy. Consumer discretionary, some fears over consumer spending that in hindsight turned out to be relatively unfounded. Energy, we saw a decline in oil prices. Materials, we saw some some headwinds in materials, although we saw some notable increases in several commodities, which we'll talk about in a second. Healthcare, financials, utilities. And then, again, industrials over here, you've got the infrastructure, spending that needs to happen. And so these caught a bit of a bid over the course of the year. And just as I mentioned, the leadership in the market is driven by very large technology companies that have exposure to this artificial intelligence theme. You've got Alphabet or Google here, which when you think about what drove equity returns this past year, you can say that Alphabet or Google accounted for about 20% of that. If you're looking at the S&P 500, Nvidia, lots of press during the year, about 16% of that. So the top two companies accounted for well north of 30%, 35%, honestly, of the total return in the market last year. And if you add Broadcom and Microsoft to that, you can see that you're getting, really kind of close to 50% that's being accounted for by essentially four stocks. And then the rest of the S&P 500 essentially accounted for about 41% of the total return, and then rest of kind of Mag 7, et cetera, about another 10%. So again, narrow leadership in a market that towards the end of the year had some increase in breadth, which was a positive thing to see. But obviously, this is not a kind of a sustainable thing to put your hat on, because then you start getting issuer risk and volatility. If, say, like Google or Alphabet comes out with kind of a disappointing quarter, or maybe just growth, albeit robust, that just happens to fall short of these lofty estimates, and then you get the stock selling off 5 to 8% in a day. It's things like that complicate the picture when you have that much narrow or that little or that increasingly narrow leadership that we've been dealing with for the last couple of years. Something else that we've been talking a lot about is volatility, and how we do expect that volatility to pick up. This is a very noisy chart, which goes back well into the 1930s, but it just shows you consecutive trading days without a 2% decline. We're now at 51. And again, there are times where you get really extended, as we did, a couple of years ago, and now we're 51 trading days, since we've had a 2% decline, and generally on average you get about 2-3 of those a year, and so I'd say we're probably a little bit overdue. I think right there at the end of the year is there was some window dressing and profit taking on the part of some fund managers that we saw a little bit of weakness, but nothing that kind of puts us in that 2% category. But I definitely think that that's a possibility here over the next several months. And we got forward PE. We do know that multiples in the United States are pretty robust. Typically, you see a level of consistency across the global markets, but we have seen a notable deviation. You can see that here, that we're basically almost 50% at a premium on our valuation relative to the global ex-US market. So another reason why, as we realized in 2025, that global markets actually had a good year. In fact, many of the international markets did better, and in some cases much better than the US. But there's still that significant value differential, which I think is attractive from a long-term diversification standpoint. Here we have the S&P 500 dividend yield, and obviously this is a function of dividends over stock price. So when you have stock prices that are moving up, you tend to have dividend yields that are going down. You can see if you go back, 1988, you draw a line of best fit here. You're going to come up with something that's probably close to, about 1.7-ish, maybe 1.6. I'm thinking, certainly if you back out, these years, which were really, really high. And again, the S&P 500, back in the 80s, 90s, and even the beginning part of this decade were dominated much more so by industrial companies rather than technology companies, which are the case now. And another dynamic to that point is that you've got an increasing number of technology stocks, and some of those just don't pay a dividend or don't focus on dividend yield. And so that's another dynamic that's at play here. And so, looking forward, we could always hang our hat on the fact that dividends accounted for about 40% of total return. I think it's fair to say that dividends may not be as high, relatively speaking, although I think there's still going to be a focus on and I think a reward for finding companies that can grow their dividends faster, even though aggregate yields may be a little bit lower. Interesting slide from Apollo. We've talked a lot over the years actually about the declining supply of equities in the market. We've gone from essentially over 8,000 publicly traded issues now down to something that's closer to 4,000 in the span of several decades. And so, basically we have half the equity supply, i.e. the number of publicly traded companies out there now than we did several decades ago. And what's interesting now is over the last several years that we've got an increasing length of time for private companies before they're able to go public. And this is a problem for private capital anyway. And we saw maybe a little bit of moderation in this last year, but it's still a problem where private equity companies are looking for more exits because they want to redeploy that capital into new investments. Investors expect a certain level of return within a certain period of time, and some of that is kind of promised to them or kind of expected within the private equity markets, and they're just simply not getting those exits, i.e. that they're companies that are being taken public. So the length of time is extending. In fact, when you look at 10 to 14 years, that's an eternity in the private equity markets, and you can see that overall over the last couple of decades that's trended a little bit higher. But again, that's something that private capital, private equity is going to have to continue to wrestle with here in the near term. Something else that I thought was really interesting coming out of the tariff tantrum is that 2025 we had a really strong inflow of foreign assets looking for investments in the U.S. And this is defined by net foreign purchases of U.S. assets. And look at this 2025 number, total investments. And I thought 2024 was a good year. 2025 just kind of blew that out of the water, despite the fact that we, for lack of a better term, went to great lengths to try to irritate all of the, our trading partners and all of that through the tariff tantrum. And where we saw the most benefit was in the equity market. So this is another issue that we want to monitor in 2026. Does this continue? Does this trend line move higher? Or does it reverse course? I mean, obviously we've got a weaker dollar and the possibility of having that dollar, at least be range bound to slightly weaker. Then that may certainly have some bearing when you think about the impact of dollar denominated assets that where those returns are being repatriated back to home country currencies there. So we don't know that, but equity markets definitely benefited. Bond market not so much. When you look at that area, but most of this delta right here was accounted for in the stock market, and yet another reason why we had a good year in stocks. Another interesting chart from Bank of America, when you look at financial assets relative to real assets, and we've had some stress in certain components of the real property market, particularly in the office market. Well known, well understood headwinds there. But what's interesting in this analysis from B of A, that actually goes back to 1925, oddly enough, and all of these different points in time and these issues that we were dealing with at those points in time. What's notable here and something that's really, I don't know, has gotten a lot of press, is that when you look at it over a 15-year time frame, right, that you had, a significant dislocation of real asset values relative to financial assets, meaning that you've had a much more rapid growth in financial assets than real estate. So again, it speaks to diversification. If you're a real estate owner, it certainly pays to have some financial assets, and conversely, given this trend and this deviation, it certainly behoove perhaps some financial asset owners to have some real property assets, and you can get some of that through alternative assets and some of the alternative investments that we have that do invest in real estate, in syndicated real estate, and some original new issue real estate. So I think this is interesting from a diversification standpoint, but also interesting from a secular standpoint, that this line has been remarkably linear over the last 15 years. Talk briefly about about interest rates here. This is the Treasury yield curve, and obviously 2025 we've had rate cuts. You can see that the bulk of the change in the shape of the curve has occurred at the short end of it. This would be basically a 10-year Treasury yield right now, which we know is right about 4.1%. That was notably higher this time last year. And you can see last year we had an upward sloping yield curve, but we had this kind of like little downtick in the longest end of the curve, the 30-year part of the curve. That looks a lot more normal right now, even though we've got this belly in here for like the 2-year, but the 2 to 10-year spread is definitely positive, and it's generally more upwardly sloping. It's more normalized, and this 2-year level right here is just the expectation of continued rate cuts down here at the short end. We're going to talk about commodities for a little bit. We've got oil markets, which very interesting news, and I'll have more to say about this, is really the arrest of Nicolas Maduro in Venezuela. You've got crude oil stocks that are very low, and gasoline stocks that, even though you look at these gray bands, these are this is kind of the historical range, and so crude oil stocks are very low. And when you look at gasoline and distillates, same thing here. What's interesting, prices are very low. I think this kind of portends perhaps a uptick in prices. And what's interesting about the crude market, and again, we're going to need to really flush this out because the situation is still very fluid, but you've got Venezuela is producing 900,000 barrels a day of crude. At one point, they were more than 3 times that, and now U.S. significantly outproduces Venezuela. But what Venezuela produces is the heavy crude that U.S. refineries are geared to take. In fact, the 6 largest refineries are heavy crude refineries in the U.S. And so, any move to kind of restart or expand oil production in Venezuela would, on the surface, be very beneficial to U.S. Refiners. All right, sliding over to non-crude assets here, we've got copper, very strong year. So there's industrial uses for copper that certainly are impacted by this. We think about building costs and things like that. 2025 was a significant year for not only the industrial, but also the precious metals. Silver had a banner year, and obviously gold, which we talk about a lot, palladium, a lot of those metals had good years. Here's kind of a broader lineup of commodity returns over the last year. As I mentioned, silver had a very strong year. In fact, beat gold. These are, non-sustainable type numbers, I would argue. But again, we just talked about copper. Ironically, cattle, beef prices, we're dealing with some, kind of specific issues there with the size of herds and essentially the supply of beef impacting that. You've got coffee that's had some tariff dynamics to it. And then aluminum, and then you get down here, other positive moves for the year. We've got nickel, zinc. Again, these are metals. Soybean oil and hogs were a little bit more. You get down here, we had some offsets to that. Cotton, corn were down. This is important for not only foodstuffs, but also for fuel. We know that a lot of corn is essentially distilled into fuel additives. You got soybean, sugar, wheat, and then as we've talked about, like natural gas, WTI crude was down for the year, and then you've got some others that kind of sit on the outlier here. Crypto was something else that was a bit of a headache. So depending on your flavor, you've got Bitcoin, which is down 4% for the year. Ethereum, which is down 10%. You've got these others that were equally stressed. You can see they were uniformly in sale mode here over the last quarter or so of the year, and it just goes to show you that you can ride that wave, and you're basically March, heading into the summer, you're feeling really good about yourself, but then you see the volatility that's inherent in these, and if you loaded up Bitcoin in lieu of publicly traded equities, you would have been sorely disappointed in your performance this year. Growth of alternative asset classes as a percent of public pensions. So we're talking a little bit more about alternative assets in general. You can see that has gone up quite a bit over the last couple of decades. And again, these are public pensions, so these are very savvy and astute institutional investors. And when you think about alternative assets being basically a third of the entire portfolio, that's something that I'll call it retail or kind of the mass affluent portfolios just have not gotten to yet. And there's a lot of reasons for that. There's understanding by advisors, and I think a tolerance factor for a lot of individual investors that more of these assets, and when we're talking about alternative assets, we're talking about assets that are not fully liquid. And when you talk about public pensions, you're dealing with very long duration portfolios, and so that's not an issue. Illiquidity is not an issue, but I could see that really the takeaway here is that we're moving farther down the road and closer to an environment where alternative assets will play a much more meaningful role in client portfolios going forward. Something I thought was very interesting to conclude with is the China one-child policy that they actually went to 2016. They went to two-child policy, and restrictions were lifted, but yet the fertility rates have continued to go down. And this is a big problem for China that is going to manifest itself in probably the next 10 to 20 years in terms of its ability with an aging workforce to replace its productivity. And I think, if you talk to geopolitical strategists, this is something that's well understood right now, and it is going to have some limits on the ability for China to grow its economy, because it's going to have to support an aging population with fewer younger age workers. And it puts a lot of pressure on them to increase automation and drive productivity from non-labor sources. That's all we have for this week. Welcome to the new year. We'll talk to you again soon. Take care.